Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different topic from the world of investment and attempt to apply the lessons as laid down by the man considered to be value investment's founding father, that is Benjamin Graham, to the matter at hand. In this edition, we should be re-examining one of the most important fundamentals of the Graham approach to investment, and that is the margin of safety principle. This principle attempts to bake in a safety net into any investment decision, for no matter how astute we are as investors, we can never fully eliminate the risk of error in our judgment, nor unforeseen things that just don't go according to plan. We shall consider the reasons why the margin of safety is of such vital importance, as well as trying to tie down what size this margin should be exactly. So let's get right down to it. As ever, kick back, tune in, and get ready to absorb another lesson in value investment, as inspired by Benjamin Graham. We as value investors like to think that we know a thing or two about placing a valuation upon a business. Through the examination of the company accounts, we can certainly do a better job than most when it comes to tying down what price should be paid for a company's stock. But of course, we are not infallible. We, like everyone else in the world, are occasionally prone to misjudgment, misinterpretation, and even to errors in our own calculations. Benjamin Graham knew this more than anybody, and so he devised a crafty solution to try and mitigate against these very risks. So what he came up with, he called the margin of safety principle. The idea behind this was that he would demand a significant discount on the intrinsic value figure that he'd arrived at in order to consider it for purchase. For instance, through analysis of a company's accounts, he may have deemed that the business was fairly worth $10 per share. But in order to ensure himself against getting things a little bit wrong, then he would demand a certain margin of safety, or a discount if you will. The size of this margin would depend on his level of confidence, but if he saw fit that a 25% margin was required, then the most he would be prepared to pay for that stock would be $7.50. The fact is that no matter how good we are as financial analysts, and all the other traits that go into becoming a proficient value investor, there are plenty of reasons why any figure of intrinsic value that we've arrived at is subject to both human error and unknowable factors. So let's kick off with good old human error. Now let's face it, no matter what job we do for a living, and no matter how good we are at that job, sometimes we just screw up. We get things just a little bit wrong. In analysis, it could be something as stupid as an error of calculation. It's something you'd hope would not happen, but analyse enough companies, and eventually the law of averages can catch up with you. This, I can assure you, is especially true if you're analysing Japanese businesses, when you're dealing in trillions of yen and trying to convert that into a dollar equivalent. But even with smaller numbers, mistakes can happen, and you just have to hope they are few and far between. But of much greater importance when it comes to human error is in regard to the more vague aspects of analysis. For instance, one of the most important things that we're looking for as a value investor in a business's historic accounts is the earnings trend, or the pattern of earnings over the long term. If we can see a strong pattern of earnings, it gives us much greater confidence that we can understand what to expect from the future. If a business has been earning $1 billion in profit every year for 10 years, then it would appear that they are operating in a pretty predictable sector, and all things being equal, we can expect the future to look pretty similar to the past. But what if we're wrong about this? Up until 2007, when Steve Jobs appeared on stage brandishing an iPhone, I'm sure the earnings of Nokia looked pretty smart and consistent too. The fact is that nothing is surefire or guaranteed in the world of business, and the past, which is ultimately what we're dealing with as value investors, is never an exact indicator of the future. As well as the unknowable risks tied specifically to individual businesses, we have of course the more general risks. These might be the financial crashes that crop up from time to time, pandemics, which should still be fresh in the mind, and likewise global conflicts that can do so much to upend economies. We can be wrong, of course, as value investors on all manner of things. Some will be our own doing, others just simply unknowable factors. But the margin of safety principle is there as a sort of insurance policy against all these factors, and in most instances it will provide a big enough buffer zone to get us out of jail. So if we can see that demanding a margin of safety seems like a sensible solution to help us manage the risks tied to getting things a little bit wrong from time to time, then what should that margin of safety be in percentage terms? The answer to that question, I'm sure you're not surprised to hear, is that it depends. Clearly, some investments will require a bigger margin over intrinsic value than will others. So we can already see that this is not going to be an exact science and will require some level of judgment on a case-by-case basis. Let us take what may well be two extremes to demonstrate what I mean. If we're perhaps dealing with a business that operates in an industry that has a long-term history of solid earnings and operates in a sector that has low probabilities of suffering a dramatic or sudden change in fortunes, then potentially the margin of safety we would demand here may be lower. I'm thinking here perhaps of tobacco businesses, because regardless of what you think of the very long-term future of the industry, you still have billions and billions of people addicted to the stuff, and that isn't going to change anytime soon. Wars, pestilence, depressions, people are still going to need their hit, and this will continue to drive profits. There is of course still a chance of being wrong on this score, but this is much lower than in many other industries that may be more cyclical, where their fortunes operate in cycles, or the ones where the chances of obsolescence or extinction are greater. The exact margin the value investor should demand will come down to their own personal judgment around the risks tied to the financial appraisal of a particular business. In my own dealings, this figure is rarely ever out of the region of 30 to 40%. For me, this provides a nice comfort blanket against all the things that can typically be expected to go wrong. In very rare cases, I may be prepared to accept a lower margin, but this would only be for a particularly exceptional business with a strong history, paying out highly attractive and durable dividends. But in the main, for me, the level of between 30 and 40% is the Goldilocks zone. What you determine this level to be personally will naturally be down to your own levels of confidence in your analysis and the future of the company. To conclude, we can say that employing a margin of safety into any investment is of vital importance. It provides protection against the unknown and unexpected, just like any other form of insurance does. None of us would fail to have insurance on our own home. If nothing else, it provides peace of mind. That some investors are quite happy not to insure themselves about being wrong in their judgments sounds to me a bit arrogant and very foolhardy, and I'm not quite sure how they sleep at night. The ability to employ the margin of safety principle is a luxury that is mainly only available to value investors. It won't work at all for growth investors, as clearly it depends on having an intrinsic value to work with in the first place. And those types of investors are not basing their decisions on the fundamentals of what the stock is actually worth. They are basing it instead on what it might be worth in the future, based upon all manner of guesswork and crystal ball gazing. The margin of safety principle is there to protect us from ourselves, against our own folly and mistakes, and we should always ensure that we bake it into any decision when it comes to the purchase of a stock in a business. On that point, I shall draw this edition to a close. I do hope you've enjoyed it, and it brings into stark contrast the importance of this central tenet of value investment. If you have enjoyed it, please do add to playlist so you'll be alerted as soon as any new additions land on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.